life insurance is likely one of those things that's a little bit confusing. Before we dedicated our careers to helping teaching people about life insurance, I know it was confusing. And I'll even say this. Sometimes as I've been doing it, I've had to double take. So life insurance it genuinely is a complex vehicle. So today we're going to do this. We're going to break down the 5 primary types of life insurance so that when you leave from watching this, you understand what they are and at least the basics of how they work. Okay. So, to get things kicked off, we'll start with the most simple type of life insurance, term insurance. Rod, take it away.
Yeah, term insurance is really simple. It's set up so that you pay a premium, really inexpensive premium, so that if you die, then there's this life insurance, this death benefit that pays out to your family or your business or to a lender. There are a lot of different reasons why someone might want to have term insurance. And then you're picking a certain period of time. So 10 years, 20 years, 30 years, your premium stays level for the entirety of that time. And so that if you pass away during that time, death benefit pays out. More likely, you won't pass away, right? You stop paying the premium, the insurance goes away.
Okay, term insurance is simple. I like to think of it like auto insurance. If there's an incident that takes place and I've been paying my premium, the insurance company then comes in and covers that. But that's the extent of my relationship with the insurance company, right?
Yep.
Okay, so now we're going to get into what would be qualified as cash value types of life insurance. And there's really 4 of them. Whole life, universal life are kind of the core. And then there's some variations of universal life that's variable universal life and indexed universal life. I know it's kind of confusing, right? But whole life insurance is our starting point. It was the first type of life insurance that was created. It was meant to be foundational, solid, guarantees, stable. I know what I'm going to get. So here's how whole life insurance works. First of all, now that we've moved into the cash value side of things, I have my death benefit on one side. I've got a cash value component. It's a bucket of money that actually builds up while I pay my premium. So as I put my premium in, a portion of it is going to go to cover the death benefit costs. The other portion is then going to go into this cash value where it can earn interest depending on the type of life insurance I have, right? With the whole life insurance, that cash value is built up in an incredibly stable and predictable way. It builds in 2 ways. First is through the guaranteed interest rate, and every whole life policy has a guaranteed interest rate associated with it. Most commonly today, you're going to find something in the 3% range. Could be a little bit less, could be a little bit more, but that's about typical. The second way that whole life insurance grows that cash value account is through dividends. What's unique about whole life insurance is that when I purchase it, particularly if I'm working with a mutual company, now I'm participating in and owning a portion of the insurance company, and therefore the earnings come back to me in the form of a dividend. So I have my guaranteed interest rate, I got my dividend. Today you can expect another, couple percent on top of your guaranteed interest rate. We usually tell people when a policy's been built the way we do it, which by the way is critically important because, and we're not going to get into the details for today, but the way that life insurance is structured has a huge impact on what it will actually do for me. So for us, everything that we do is minimum cost, maximum cash. So we're going to talk about these policies as if they've been built what we would call optimally for the client. Okay. So back to our whole life insurance, it's growing in 2 ways, the guaranteed interest rate and the dividend. And normally I can expect to be somewhere in the 5-ish% range. Now, history is a big part of it. When interest rates are higher, it could go higher. If interest rates are lower, it could be a little bit lower. But if you go in expecting somewhere in that 5% range, you're going to be pretty happy with what you get from whole life insurance. Okay. So, Rod, that takes us to our next version of life insurance, which is universal life insurance, which is kind of built to be a hybrid between whole life and term insurance. Talk to us about that.
Yeah, in its purest form, universal life can be, I call it permanent term. So, in other words, I want to pay the least premium possible, but I want to make sure the death benefit lasts the rest of my life, no matter how long I live. So now I'm not saying just for 10 years or 20 years or 30 years, like on the term side, I'm actually building a cash value component to it. But I'm also saying I'm not concerned about getting all the guaranteed interest like you just described with whole life. I'm not as concerned about that dividend. All I want to do is say, I want to pay some premium and know that the death benefit pays out. So it's less about the cash value component, more about just the pure death benefit, but making sure it's permanent. So like you said, the premium is going to be higher than it would be on term, which is expected, right? It's not just for 10 years or 20 years. It's for the rest of my life. If
My
I'm
lifetime.
40 years old, then I could be 50 years later before it pays out. Therefore, higher premium in order to take care of that. But the point is, in this case, again, as long as I pay my premium, the death benefit's going to pay out. And there's some flexibility in there. I could build it so that it's paid up over 10 years and then is designed to last the rest of my life. There is some flexibility in here because of that cash value component. It just adds a little bit of maneuvering that can be done to be creative with it. But that's the point. And when we talk about just pure universal life, we're not as worried about the cash value, more just creating that death benefit.
Okay, perfect. So, and that is the most typical kind we see. Now, there's life insurance is complex and there's a lot of variations of this. So let's go into the last two, Rod. The fourth one that we're going to talk about is variable universal life insurance. And really what we're talking about here is instead of the cash value growing in association with interest rates, now my cash value is going to be based on market performance. So what happens is my side account, my cash value is built up of what they call sub accounts, which are just mutual funds. So now I'm investing in mutual funds in conjunction with my policy. So that means that I can gain, I can produce, high returns, but I also have the possibility of losing money. So with variable universal life, I have to be conscientious of how that investment account's doing and what kind of impact it's going to have on the actual policy, because obviously if we're getting negative returns, then it's going to pull from the life insurance policy. On the other hand, if I've got juiced up returns, then it's going to really make the policy hum. So variable universal life, very simple in the sense that the way that it's growing is just based on market conditions. That's what I need to be focused on. Okay, Rod, finally, I want you to hit on index universal life as our last type of life insurance.
Yeah, indexed universal life. Now, so similar to what you just talked about in terms of we've built some cash value. How is the cash value growing? Well, this is kind of a hybrid between the first one I described, the just universal life, which the insurance company just pays you interest. The second one was variable universal life. It's based on what's happening in the market. You literally are invested in the stock market and it rises or falls depending on what's happening there. With index universal life, it's kind of somewhere in between. What's happening is we're using a market index like the S&P 500 as an example for the measuring stick to determine how much interest I'm earning each year. But I'm not actually invested in that market index. It's external, right? My money's never at risk. That's the biggest point, is it's not at risk. So in other words, in a year where, in this example, the S&P 500 is growing, I participated in a portion of those gains up to a cap. And as we're recording this right now, the caps are right around 9 or 10% if it's the S&P. On the other hand, in a year where the market goes down, the S&P goes down, I don't participate in those losses. I just don't earn any interest in that year. So I have a floor of 0, a cap of 10. I know I'm going to earn something in between there. I think the best way to think of it is that you can capture a good portion of the upside of what the market is doing, but you have downside protection. You don't participate in the losses. That's what a lot of people like about it.
Okay, let's do a quick recap, Rod. We talked about first term insurance, whole life insurance. Universal life insurance ends up being a little bit of a hybrid between whole life and term insurance. We talked about variable universal life. We've talked about index universal life. And to your point, Rod, the reason people really like index universal life insurance is because of the potential to get higher returns without that same downside risk.